Most people wait for Bank of Canada announcement, but there is another number quietly moving your mortgage rates. Most people wait for Bank of Canada announcement, but there is another number quietly moving your mortgage rates right now. One most people never check. There's another number. Most people wait for Bank of Canada announcement. Most people wait for Bank of Canada announcement, but there's another number quietly moving your mortgage rates up right now. And most people are never checking that. It's called the bond yield. And in Canada, it just spiked. Today, I'm breaking down what that means for your mortgage, your buying power, and what it means for the BC real estate market in plain English in under 10 minutes. I'm Roshan Victor, a Fraser Valley realtor, and on this channel, I cut through the noise in BC's housing. And on this channel, I cut through the noise on BC housing, interest rates, and what buyers and sellers actually need to know before making a move. Let's get into it. But before that, if you haven't done so, subscribe to the channel, hit the bell icon, and if you want a one on one consult with me, there's a link in the description below. What are bond yields and why should you care? Think of bond yields like IOU, the government issues. When investors buy a Government of Canada bond, they are lending money to Ottawa in return for Ottawa paying them an interest. That interest rate is the yield. Here's the part that matters for you. Fixed mortgage rates follow the 5-year Government of Canada bond yield. When that yield rises, lenders' funding costs go up, and fixed mortgage rates either rise or stop falling. That's exactly what's happening right now. As of mid May, the 5-year Government of Canada yield hit 3.35% on May 19th, then pulled back to 3.2% by May 22nd. The 10-year bond yield moved from 3.7 to 3.53 in a very small window. Notice something? It spiked and then retreated slightly. This is not a straight line up. This is volatile market reacting to inflation, oil prices, central bank signals, and global uncertainty. TD economists show Canada's 5-year yield went from 2.6% in Q1 of 2025 to a forecast of 3.1% in Q2 of 2026. The 10-year moved from 2.97 to 3.5. That's roughly a 50 basis point increase, and that's half a percent. Half a percent sounds small, isn't it? On a $700,000 mortgage with a 25-year amortization, a half a percent rate increase adds a meaningful amount to your monthly payment. Enough to affect what you qualify for and whether some buyers can enter the market or not. Why are yields rising? There are four reasons. First, inflation is back in the conversation. Statistics Canada reported that the CPI was at 2.8% year over year in April of 2026, up from 2.4% in March. The culprit, the energy, up from 19.2%, with gasoline alone up by 28.6% year over year. Bond investors hate inflation. If they think it'll stick around, they demand a higher rate to lend money, which pushes yields up. Second, the oil shock is adding uncertainty. Higher oil prices ripples into transportation, food, and business costs. Markets start asking, will inflation stay sticky? Will the Bank of Canada delay rate cuts? Now, the third reason, rate cut expectations are fading. A TD economist noted that while higher oil prices lifted the headline numbers, there's not yet broad knock on inflation in other goods and services, but the market is pricing in caution. Even the possibility of a delayed cut keeps bond yields elevated. The fourth, governments are borrowing heavily worldwide. More bond supply means investor demand, higher yields to absorb it. Canada isn't alone here. This is a global dynamic. This inflation isn't broad based, it's concentrated in energy and transportation. But BC households feel it directly at the pump, in the grocery store, in daily costs, and bond markets react to the headlines, not just the fine print. And specifically, BC is uniquely exposed to the rate pressure because of our price levels. In Greater Vancouver, the Fraser Valley, Langley, White Rock, borrowers aren't dealing with small mortgages. So when the rate moves even slightly, affordability shifts fast. BCREA reported 6,311 residential MLS sales in April of 2026, down 1.9% from April of 2025 and 25% below the 10-year average. The chief economist cites the oil supply shock, upward pressure on rates, alongside local labor market uncertainty as the key forces suppressing demand. Separately, BC's inflation came in at 2.5% year over year in April, unchanged from March, and rent growth slowed sharply to 3.4%, down from 6.4% a month ago. That tells me BC isn't overheating from local demand pressure. The affordability challenge is coming from the rate side. Here is the on the ground reality. On a $700,000 mortgage, a 0.25% to 0.5% rate increase can add hundreds of dollars to monthly payments. That's the difference between qualifying and not qualifying, between moving forward and staying put. This is why buyers are saying prices are lower, but my payments isn't much better. Affordability isn't just price, it's rate, income, qualification, all four together. Affordability isn't just price, it's price, rate, income, qualification, all four together. The BC market isn't collapsing, but it isn't recovering. The BC market isn't collapsing, but it isn't recovering either. It's a market in a holding pattern where buyers want to move but are waiting for a clearer signal on rates. That creates real opportunity if you know how to read it. Buyers have more negotiating room than they had years ago. Buyers have more negotiating room than they had a year ago. Sellers need to price sharply. Strategy matters, and more than that, timing matters. Investors need cash flow, and investors need cash flow math to work, not just appreciation math. My take: higher bond yields don't automatically crash the housing market, but they can stall momentum. We did see a brief momentum in the spring market, but with the bond yield rising higher, that may slow down. When buyers who were counting on falling fixed rates suddenly see them flat or rising, some pause, some qualify for less, and that hesitation keeps the market slower for longer. But here's the flip side: a lot of buyers are already on the sideline waiting for prices and waiting for signals. If bond yields stabilize or start falling again, confidence can return quickly. Let me share an example. I have a couple of clients who are dabbling between condos and townhouses. They have enough to buy a decent two-bedroom condo in Willoughby, but they're just in touching distance of a three-bedroom townhouse. The difference, $650,000 to $700,000, and they are somewhere in between. So the hope from their end is, let's wait and see if the $700,000 townhouse can come down to 675 and we can buy, rather than hurrying into a condo market which is dropping by the day. That's what makes the next few months so important. The market is finely balanced, and bond yield movement are one of the key triggers. Stop watching only the Bank of Canada. Watch the bond market is what I would recommend. Bond yields are the quieter force behind your mortgage rates, your buying power, and the direction of this housing market. A half a point movement in the yield can change what you pay on a monthly basis, and this is specifically important for first time home buyers or people looking at renewing their mortgages and looking at locking it on a 5-year term. If you're thinking about buying, selling, or investing, this is not the moment to rely on headlines. Run your numbers for your situation with your local market in mind. I'm Roshan Victor. Subscribe to this channel if you want to know more about the real estate market, and if you want a one on one consult, there's a link in my description below. Let's have a chat. See you in the next video.